If you want to buy a house, buy a car, or achieve total financial freedom before November, you no longer need to suffer at a 9-to-5 job. Originally, this wealth building opportunity belonged only to Americans. Because the whole world can invest in US assets, as long as you know how the game is played, the US government will practically deliver money right into your hands. I'm talking about at least the value of a house. What does this mean, and how does it work? The US midterm elections are coming up this November, and before voters head to the polls, the government will do everything in its power to make the stock market skyrocket. Why? Because inflating your wallet is exactly how they get Americans to vote for them and keep their political allies in power. Therefore, the months leading up to November present a massive opportunity to pick up free money if you know where to look. Is this really how the system works? Hello everyone, and welcome back to Stewardship Finance Academy. Although we are talking about the November elections today, we are not talking about politics. We are talking strictly about making money. Let's look back at the US presidential election in 2024. Both the data and the news cycles strongly indicated a high probability of Trump winning the presidency. If you had bought Tesla stock back then, knowing Elon Musk was heavily backing the campaign, your assets would have multiplied by 2.5 times when Trump took office. Simply put, if you bet correctly on who will win the presidency and buy the stocks heavily tied to their administration, you can generate massive sudden wealth. Many people think this kind of money-making opportunity only comes once every 4 years during the presidential cycle. But that is completely false. In the United States, the midterm elections held every 2 years are actually far more important than the presidential election. Let me explain why. If you look at the United States as a massive corporation, electing a president is really just electing a CEO to manage the company for 4 years. The CEO decides the general direction of the company, but the midterm elections determine who sits on the board of directors for this company. If the board of directors is unhappy with the CEO, they can reject absolutely anything the CEO wants to do. Therefore, Congress is what really controls the United States, not the president. If the president wants to cut taxes today, he can only propose the idea. Whether the country actually executes those tax cuts requires a nod of approval from Congress acting as the board of directors. Even if the administration wants to appoint top officials, they need the approval of Congress. In other words, if the people in Congress are not aligned with the current administration, the entire executive branch gets sidelined. To put it harshly, the president's orders might not even make it out of the White House. Furthermore, hostile Congress can investigate and impeach the president. When that happens, you aren't worrying about cutting taxes anymore. You're worrying about whether you're going to jail after your term ends. This is exactly why the current administration absolutely must win this midterm election and pack Congress with their own loyalists. But here's the massive problem they face. How do they actually win? Over the past several decades, in 8 out of 10 congressional elections, the incumbent president's party loses. Most of the time, American voters elect the opposition party to Congress. Why? Because voters naturally favor checks and balances. Americans don't want the president dictating everything unchecked. If the CEO can do whatever he wants without oversight, all the company's money ends up in the CEO's wallet. Congress exists to monitor the president. If you do well, they urge you forward. If you perform poorly, they come after you. However, in the last congressional election, the president's party actually won. So the current US administration has the power to do whatever it wants right now. They could directly pull money out of the treasury, hand it out to swell everyone's wallets, make your life instantly better, and naturally sail their candidates right back into Congress. And because Congress is currently controlled by loyalists, nobody would object to this massive spending, but just handing out cash doesn't guarantee an election win. Even with cash handouts, the underlying economy can still be terrible, leaving people in misery and causing the stock market to crash. Most importantly, to hand out money, you actually need to have the money to distribute. And where does that liquidity come from? It comes from the Federal Reserve. US interest rates are set by the Federal Reserve. The higher the interest rates, the more expensive money becomes. When money is expensive, the government and major corporations cannot afford to borrow it. Without cheap debt, the economy stalls. And right now, knowing there is an election coming, the Federal Reserve has completely stopped cutting interest rates. US interest rates are currently sitting higher than inflation. This means if I have cash, I would much rather save it in a high-yield account than leave it in the market to depreciate. If all the capital gets locked up in bank accounts, the broader financial market dries up. Furthermore, the total supply of US dollars is also controlled by the Federal Reserve. If they refuse to print money, or worse, if they initiate quantitative tightening, it's like turning on a money shredder. They collect US dollars from the system and burn them, leaving the markets completely starved of capital. So, if the administration wants to win the November midterms, they desperately need their own hand-picked person to take over when the Federal Reserve chairman changes this May. But here's where the plot twists. The exact candidate the US government is backing to become the next Fed chairman has openly stated he wants to keep the money shredder running and shrink the balance sheet. Why would they tear down their own stage right before an election? Let's think critically about human psychology. As we just established, the historical win rate for an incumbent government keeping Congress is only about 20%. If you are running the government and you desperately need to win, do you let the public eat and drink to their fill right now? Or do you intentionally starve them and let them suffer first? Theoretically, if voters are always well-fed and living comfortably, and you keep handing them money, they should be grateful, right? But human nature dictates that when people are completely comfortable, they start feeling like the government still isn't doing enough. With nothing pressing to worry about, they find reasons to criticize the administration and vote for the opposition. Voters start feeling entitled to their comfort, convincing themselves that a new leader would give them even more benefits. But flip that scenario around, and the public is living in absolute economic misery, struggling to afford groceries and rent. If the government suddenly descends like an angel and aggressively bails them out right at the peak of their suffering, what happens? That is when the public becomes overwhelmingly grateful and eagerly casts their votes for the incumbents. In other words, to win this midterm election, the US government won't just blindly throw money at you today so you can complain about them tomorrow. They are going to let things break first. And when that flood of money finally comes, are you prepared to catch it? Or will you just be the last person to enter the market, left holding the bag for the elites? If you don't want to be a sacrificial pawn in this political game, and you actually want to use this engineered volatility to cross social classes, you need to understand exactly what is happening behind the scenes. And because we are about to dive into some incredibly dense macroeconomic data, if you are worried about forgetting these crucial details, simply hit the like button right now. Liking this video automatically saves it to your YouTube playlist, allowing you to easily come back and review this exact blueprint whenever the market shifts. By the way, if you want to master the exact strategies the wealthy use to front-run these market shifts, I highly recommend you check out the SFA Free Stock Investment Masterclass. The link is right down in the description below, and it will completely change how you view the stock market. Now, let's look at the data. The US government needs massive amounts of capital to create this pre-election boom, and most of that money must be borrowed, so the administration desperately needs borrowing costs to drop. Last year, the Federal Reserve continuously cut interest rates. Why did they do it? They publicly stated it was because the US non-farm payroll data had severely worsened. Because Americans allegedly couldn't find jobs, the Fed lowered rates to encourage corporations to borrow cheap money and hire people. But who actually publishes this non-farm payroll data? The US government does. This raises a massive red flag. If the government can manipulate the employment data, can they manipulate the Fed into cutting rates on demand? Let's look at how fake this employment data really is. Historically, during a healthy economy, the US adds well over 1 million new jobs in a single year. But the initial number published for last year was only 584,000 jobs. That's a direct 50% cut, which was already alarming. It gets much worse. The US government recently revised that exact same data again. It quietly admitted to the world that the actual number of new jobs added last year was a catastrophic 181,000. Think about that. It's like taking a test where you normally score a 90. They hand your test back and say you got a T5. Then, a few months later, the teacher pulls you aside and admits you actually only scored a 10. And in the past 26 reports, this data has been heavily revised downward 25 times. Normally, the economy adds over 1 million jobs. Last year, it really only added 181,000. If you were the Federal Reserve, wouldn't you be terrified of completely destroying the US economy if you didn't cut rates? So they cut rates. But here's the massive contradiction we are facing right now. Since the real job market was that horrific, current interest rates are still historically high, why did the Fed suddenly pause the rate cuts this year? Yeah? Shouldn't they be panicking and slashing rates to zero? If only 181,000 jobs were added last year, that averages out to just 15,000 jobs a month. The market naturally expected that after last year's rate cuts, employment would slightly recover, projecting roughly 65,000 new jobs a month this year. But suddenly, the newly released January data claimed a miraculous 130,000 jobs were added in a single month. It's like scoring a 10 on your exam, getting a little bit of tutoring, and suddenly walking out with a perfect passing grade that completely shatters all expectations. Because of this miraculously strong data, the Federal Reserve completely halted their rate cuts. But does this data reflect reality at all? Let's use some common sense. Last year, while millions were struggling, the government blamed AI for replacing human workers. So this year, with a sudden explosion of 130,000 jobs in 1 month, did humans magically replace AI overnight? The actual news on the ground paints a very different reality. Countless major US corporations are not only continuing layoffs, they are accelerating them. For example, the massive payment company Block recently announced that AI had made many roles obsolete, resulting in them firing half of their entire staff. Last year, the tech sector alone laid off 140,000 people. And in just the single month of January this year, another 50,000 corporate layoffs were announced. Yet somehow, the official US employment data is getting better. There are only two logical possibilities here. Either the Bureau of Statistics is completely blind, or they are intentionally feeding the public these specific numbers. If it's the second option, they have exactly one goal: forcing the Federal Reserve to delay cutting interest rates right now. Why delay the cuts? Because if they cut rates right now and inject liquidity, the public will just take the economic relief for granted. Voters will take the money, complain anyway, and still vote for the opposition in November. In political science, this is known as the political business cycle theory. It proves that when the economy is stable and strong, the ruling party is actually far more likely to get voted out. But if you intentionally sabotage the economy first, making the middle class feel the brutal sting of layoffs, maxed out credit cards, and foreclosures, when you suddenly step in as the savior right before the election, the voters will be overwhelmingly loyal to you. You create a devastating problem first, just so you can take credit for solving it later. So the US government absolutely plans to cut interest rates and flood the market with liquidity, but they are deliberately pushing the timeline right to the edge of the election. Think of it like a superhero movie. The villain blows up the city, and the hero dramatically drops from the sky to save the day while the crowd cheers. But what if the person planting the bombs and the hero saving the city are the exact same person? Let's look at the current Federal Reserve Chairman, Jerome Powell, who was appointed by Trump himself back in 2018. But listen to how Trump speaks about him today. Calls Powell an enemy. He claims Powell is deliberately sabotaging the economy to make him lose the election. The man he appointed has suddenly become his biggest public rival. Some analysts claim Powell is simply trying to prove the Federal Reserve is an independent body that doesn't answer to the president. The more the administration demands rate cuts, the more Powell stubbornly refuses. But regardless of the real motive, Powell has been cast as the absolute perfect villain in this political theater. If the economy is terrible right now, who takes the blame? It's Powell's fault. It's the fault of the rogue central banker who refuses to listen to the president and refuses to cut rates. But Powell's term ends this May. As soon as he steps down and the administration's hand-picked successor takes over, the script flips. The new chairman will immediately announce massive interest rate cuts, aggressively bailing out the markets and injecting trillions in liquidity. The public will look at this and think, all of our previous suffering was caused by that disobedient Chairman Powell. Now that the administration has their own guy in charge, the economy is booming again. When November rolls around, who do you think those relieved wealthy voters are going to support? This is the most brilliant, highly engineered wealth transfer script in modern history. You don't need the villain to actually be evil. You just need him to stand in the right place at the right time to take the fall. Powell might not be a traitor at all. He might be playing his exact assigned role as the designated scapegoat. Meanwhile, the real directors of this economy are watching the theater play out from behind the curtain. Just look at the absurdity of the numbers. 180,000 jobs for the entirety of last year, compared to 130,000 jobs magically appearing in a single month this January. Do you honestly believe the hundreds of thousands of workers displaced by AI all found new careers overnight? If the employment data is manipulated and the underlying economy is actually fracturing, yet the Fed refuses to cut rates based on those fake numbers, when the inevitable crisis hits, the Federal Reserve will perfectly absorb all the public outrage. So, strictly following the logic and the data we are seeing right now, there won't be a mindless bull market straight into November. There is a massive mathematical probability that they will intentionally allow the market to crash first, creating the perfect environment for their new chairman to step in as the savior. If you look at the technical charts, the US stock market has been trapped in a sideways horizontal consolidation range since last October. Every time the index pushes up to a specific resistance level, it violently rejects and sells off. And every time it drops to the underlying support line, institutional buyers step in and bounce it. The market has no clear direction. It is just chopping back and forth within this tight, volatile channel. This is absolutely not the behavior of a healthy bull market. This is a distribution phase where massive institutional whales are quietly offloading their risk onto retail investors. What we know for a fact is that the risk of holding traditional long positions in US equities right now is historically high. The major indices are constantly slicing right down through their 50-day moving averages, only to get artificially pumped back up. This means retail investors who bought the dip over the last 50 days are being violently whipsawed between brief profits and sudden sharp losses. In a real sustained bull market, the index almost never breaks below that 50-day moving average. You just buy, hold, and profit. But this current volatility is systematically designed to shake out weak hands and maximize risk for everyday investors. That is exactly why our team at Stewardship Finance Academy uses a highly adaptive guerrilla warfare strategy in the markets. We are significantly more agile than traditional funds. Warren Buffett needs a year to efficiently offload his positions. We only need a single second to execute a trade, secure our profits, and exit. Let me ask you a question about risk. If I told you a specific stock trade had a 99% probability of failing, Would you take the trade? Most retail investors would instantly say no. But what you failed to ask is the most important question in finance. What is the actual dollar risk versus the dollar reward? If I take 100 different trades today and 99 of them fail, costing me exactly $10,000 per loss, I have lost $990,000. But because of asymmetric risk, if my one single winning trade yields $10 million, I still walk away with over $9 million in pure profit. That initial $990,000 drawdown was simply my mathematical cost of doing business. Win rate is a heavily marketed metric, but your payout ratio, or asymmetric odds, is what actually creates generational wealth. When you compound this specific risk-to-reward ratio over the long term, you mathematically guarantee that your massive wins erase your tiny calculated losses. To the untrained eye, aggressive trading looks like gambling, but when executed with strict parameters, it is the purest form of high-level investing. For 2026, I have packaged this newly refined, highly adaptive investment system into a completely free public welfare masterclass. However, the server capacity for this specific trading is extremely limited. I highly urge you to click the very first link in the video description right now and secure your spot in the SFA free stock investment masterclass. In the financial markets, this engineered volatility is called squatting down before you jump. The deeper they force the market to squat in the first half of the year, the more violently it will explode upward in the second half. The political elite are making your portfolio bleed right now, specifically so you will drop to your knees and thank them when they bail you out right before November. I know this sounds incredibly cynical. You might be asking, is the United States economy really that fragile? Can it be crashed that easily? If you have been following the data we share, you already know the US is currently in the middle of a severe underlying liquidity crisis. The capital held in US deposit reserves, along with the Federal Reserve's overnight reverse repurchase facility, have entirely collapsed down to the absolute red line. These are the ultimate emergency lifesaver funds for the financial system. To put it simply, commercial banks are so severely starved for cash that they have been forced to relentlessly drain these emergency reserves just to stay afloat. But those funds are virtually gone. They have been spent to the absolute limit. So what happens next is the most crucial piece of the puzzle. Kevin Warsh, the insider, heavily favored to take over as Fed chairman, has already telegraphed his exact playbook. He has stated that his very first major objective is to massively relax bank reserve requirements. What does this actually mean for your money? Currently, banking institutions worldwide must strictly abide by a financial regulation known as the Basel Accords. Here's how it works. If you deposit $100 into a checking account today, the Basel Accords dictate that the bank is only legally allowed to lend out $80 of your money. The remaining $20 must be locked securely inside the bank's vault. It cannot be touched, traded, or lent out under any circumstances. This strict regulation exists to prevent catastrophic bank runs. If everyone suddenly panics and demands their cash, the bank needs vault reserves to avoid total insolvency and collapse. Because of this rule, a massive multi-trillion-dollar portion of the total money supply in the United States is currently locked behind bank vaults, completely inaccessible to the broader economy. But what is the new Federal Reserve Chairman preparing to do? He is preparing to shatter this rule entirely. Instead of requiring banks to lock away $20 out of every $100, the new chairman could grant sweeping permission for US banks to only hold $10 in reserve. By simply changing a regulatory fraction on a piece of paper, the total amount of available fluid cash in the financial markets instantly explodes. They could even push it further, allowing all $100 of your deposit to be instantly weaponized and lent out into the economy. This single policy shift instantly unlocks trillions of dollars that were previously trapped in commercial bank vaults. And where will all this newly liberated capital flow? It will immediately be used to buy up US government bonds, issue massive loans to American corporations, and aggressively pump up the domestic economy. This mechanic is called domestic liquidity injection, or shadow quantitative easing. By releasing the money trapped in vaults, they guarantee that the US domestic markets are flooded with cheap capital right before the election. When you suddenly unleash trillions of dollars into the market that must be deployed, it directly and violently pushes up the price of equities and assets. But here's the massive catch. This vault money is strictly classified as emergency capital. It is designed to be the ultimate safety net. By law and economic convention, as long as the US financial system is stable, you cannot justify releasing it. So, if the incoming Fed chairman desperately wants to deploy this capital to pump the markets, what is his only option? It's terrifyingly simple. You have to manufacture an emergency. First, allow the banking sector to fracture. You let a few over-leveraged regional banks collapse. You let the financial system crack just enough to induce widespread public panic. Once the public is terrified, the Fed chairman steps up to the podium and self-righteously declares that a crisis has arrived. And therefore, emergency reserves must be unlocked to save the country. This is exactly why when the new chairman takes power in May, his first move will not be an immediate bailout. His first move will be to stand back and watch the markets bleed, because if the markets don't crash, the political justification to unlock those trillions in vault reserves will never exist. Only a severe market correction gives them the legal and public mandate to release the floodgates. And once they release that liquidity, they get to parade themselves as the brilliant heroes who saved the working class from ruin. They start the fire and then demand praise for showing up with the fire extinguisher. Furthermore, if the fire isn't massive and terrifying, the person putting it out doesn't look like a hero. The crisis must be deep enough to justify the extreme bailout. Releasing the reserve requirements is just phase 1 of the operation. Phase 2 happens once the market is flooded with this new bank liquidity. They will immediately pivot to aggressive interest rate cuts. Most people assume rate cuts are just designed to make mortgages and auto loans cheaper for the middle class. They think it's about helping corporations hire more staff and stimulating Main Street. That sounds nice, right? But have you ever stopped to calculate who is actually saved first when rates drop? It certainly isn't you. The primary beneficiary of interest rate cuts is the United States government itself. The US national debt has violently breached the $38 trillion mark. Because their debt pile is so astronomically high, for every single 1% drop in the interest rate, the US government saves hundreds of billions of dollars a year in debt servicing costs. Slashing interest rates is essentially giving a massive multi-billion-dollar blood transfusion directly into the veins of the federal government. So they crack open the bank vaults to flood the streets with cash, and they slash interest rates to drastically reduce the government's debt burden. Suddenly, the corporate market has unlimited money, and the government has unlimited breathing room. The domestic US economy is artificially supercharged, but then comes phase 3. This is the most ruthless, globally devastating move in the entire playbook. While simultaneously cutting rates, the Fed chairman will turn on the money shredder and initiate quantitative tightening. Wait a minute, doesn't shrinking the balance sheet drain liquidity and crash markets? How can that possibly be a bailout tactic? Yes, shrinking the balance sheet absolutely drains liquidity. But you have to pay very close attention to whose liquidity is actually being drained. The new chairman's quantitative tightening program will not be targeting domestic US dollars. It will be explicitly designed to shred US dollars circulating globally. What does this mean for the rest of the world? The Japanese yen is strictly Japan's currency. Thai baht is strictly Thailand's currency. But the US dollar is not just America's currency. It is the reserve currency of the entire planet. More than half of all global trade, from oil to microchips, is strictly settled in US dollars. Every single foreign nation is forced to hoard US dollars just to conduct basic international business. When the Federal Reserve initiates aggressive quantitative tightening, they are essentially vacuuming up US dollars from foreign reserves all over the globe. They are deliberately leaving foreign central banks and international markets completely starved of US dollars. This aggressively engineers an artificial global dollar shortage. And what happens to the price of an asset when there is a massive global shortage? The value of the US dollar violently spikes upward. As the dollar becomes exponentially more expensive, every other foreign fiat currency rapidly depreciates against it. When foreign currencies collapse, the hard assets sitting inside those countries, the manufacturing plants, the commercial real estate, the tech companies, the agricultural land all become absolute dirt cheap. To put it in the simplest terms possible, the Federal Reserve aggressively drains dollar liquidity from the global economy, forcing the US dollar to massively appreciate in purchasing power. Simultaneously, they unlock domestic bank vaults, handing these highly appreciated superpowered US dollars directly to American institutional capitalists. These American funds then take their supercharged dollars overseas and aggressively buy up distressed, depreciated foreign assets for pennies on the dollar. This is the ultimate, upgraded version of harvesting global wealth. In previous decades, this wealth extraction was managed entirely through basic interest rate cycles. Today, it is executed through a highly complex divergence, injecting massive shadow liquidity domestically, while aggressively draining dollar liquidity globally. Once the engineered global crisis passes and these foreign assets inevitably bounce back to their true valuations, the trap is complete. We will witness the most shocking, massive transfer of wealth in modern financial history. Trillions of dollars in hard value will be systematically siphoned from the global economy and permanently transferred into the portfolios of US institutions. Do you understand the magnitude of what is happening right now? This entire geopolitical financial cycle, from start to finish, is a meticulously written script. Step 1. Use heavily manipulated employment data to justify pausing rate cuts, intentionally allowing the US economy to slowly suffocate. Step 2. Isolate Chairman Powell as the ultimate public scapegoat, pushing the blame for the economic pain entirely onto him. Step 3. Patiently wait for the over-leveraged regional banking sector to fracture, because only a legitimate crisis allows them to touch the locked emergency bank reserves. Step 4. Swap in their own hand-picked Federal Reserve Chairman this May, when Powell's term expires. Step 5. Immediately following the manufactured crisis. Relax the Basel Accord reserve requirements and flood the domestic market with trillions in vault cash. Step 6. Aggressively cut interest rates to relieve the federal government's massive debt burden. While simultaneously deploying global quantitative tightening to harvest foreign assets. Step 7. Right before November, the US stock market goes completely parabolic. Retail portfolios skyrocket. The public is overwhelmingly grateful. And the incumbents sail to victory in the midterm elections. And the only question that matters is, where do you stand in this equation? When that tidal wave of capital finally hits the domestic markets, are you positioned properly to capture it? The institutional elite who wrote this script are sitting back right now. It's quietly accumulating positions while the market drops. When asset prices suddenly explode upward, they will be the very first wave to ride the momentum and cash out. What is your plan? Do you have access to the data? Are you trading with a system that puts the win rate, the asymmetric payout odds, and the mathematical margin of error entirely in your favor? Or are you going to be the uninformed retail investor who enters the market at the absolute top, left holding the bag for the institutions when they finally sell? If you want to receive our exact macroeconomic layouts, and if you want to understand precisely how we are front-running this capital shift, you need to take action. If you haven't already joined our public welfare training, and you realize that understanding market mechanics is a skill you must learn to survive this decade, do not wait. Click the first link in the video description below and register for the SFA free stock. Investment Masterclass right now. This episode was incredibly dense with macroeconomic data. We have completely broken down the underlying script from the reality of the November midterm elections, the massive falsification of job reports, the upcoming transition at the Federal Reserve, the secret manipulation of bank reserve requirements, all the way to the dual mandate weaponization of interest rates and balance sheet tightening. If you analyze this data differently, or if you have a different perspective on how these catalysts will play out, I welcome you to leave a comment below so we can have a rational, data-driven discussion. Every week, we will continue to share high-level, institutional-grade information designed to help you think like an elite entrepreneur and investor, completely free of charge. If you are serious about achieving total financial freedom and don't want to miss our next market breakdown, make sure to subscribe to the Stewardship Finance Academy channel and turn on the notification bell. And please, selflessly share this video with the people in your network who need to understand exactly what is coming. I sincerely wish every single viewer who liked this video massive success in achieving financial freedom during this market cycle. If you found even one piece of actionable insight in today's breakdown that helps you secure your financial future, then this video has served its purpose. Thank you for watching, stay sharp, and we will see you next video.